Okay, Edison, when you look at a market that's finally coming under some pressure, where do you go in terms of explaining or explaining away and staying the course?
Good afternoon, Oliver. Yeah, what a day today, right? I think volatility is among us. One of the first things I did at the depths of the downside today is just kind of put things in perspective, both for internally for our team and for clients. And looking at total returns just as of right now, right, we're still positive for the quarter despite the 2.5%, near 2.5% drawdown, and we're notably positive for the year. So as a starting point from a perspective standpoint, I think we should start there by gauging this volatility. In trying to determine kind of how valid is this, right? How valid is this from a potential further downside standpoint? How valid is it from a true catalyst, true systemic risk standpoint? You know, I'm really struggling to find a definitive and objective narrative in that process. A lot of the volatility today, a lot of the headlines did stem from the debt ceiling discussions and the rhetoric that's tied to that, which I think is purely theatrical in nature for the most part. I think to assume that the debt ceiling will now be raised amidst a still recovering pandemic time frame, I think that's ridiculous to even consider. So I'm not sure I'm buying that discussion much at all. The market has recovered notably from the lows here, at least as of right now, right? We still have about an hour left to market close. So in looking at the catalyst for that downside today, I find it very difficult to find that objective narrative that this would be sustained here in the short term.
Edison, we've had a lot of strange political events over these last 4 or 5 years that should we eliminate the debt ceiling? We had to evacuate Capitol. Is it possible, the Capitol building, is it possible that this debt ceiling actually might be an issue? Is it 0%?
You know, let's put it in the black swan category event, right? If we build that normal distribution out, we're talking about a tremendously small tail risk, right? Is it possible? Sure, it's absolutely possible.
What does that mean if it does?
I think if it does, we're talking about some serious issues in our ability to pay our bills from a fundamental standpoint. But from a sentiment standpoint, I think it adds tremendous risks and issues, both on the spending side, both on the ability for investors to feel confident in the market, retail investors, professional investors, you name it. I think it just adds this extra layer that, quite honestly, it would be extremely difficult to quantify from an extreme kind of situation standpoint. So I don't think it's possible right now. I don't think we're going to reach that because of the notion that if you look at historical precedents, debt ceiling has always been in the same kind of discussion topic as we're seeing right now. It gets the same media coverage, yet from an actionable standpoint, we do see things materializing positively out of those discussions.
Okay, Edison, I like that phrasing there, black swan event. That means repercussions big if it somehow goes negative on us. But if it does pass through and we get through it as we have generally in the past, then what's the next on the list? Because the way we think about how that progresses is, all right, we've got one risk point out of the way. Then what do we go for risk point 2 if that doesn't ameliorate our problems immediately?
Yeah, so the risk point number 2 in this case would be the issues tied to potential inflationary pressures, and then trying to gauge what are consumers going to do with their excess savings through year end, right? So the question of whether we're going to get that consumption pop through year end still remains. I do think as the pandemic is kind of easing more here on the variant side, cases have dropped somewhat, vaccination rates are still going up. There is still that pent-up demand. But the biggest risk in that number 2 spot, Oliver, is that inflationary discussion.
Okay.
And I think it's slightly misunderstood right now. And what I mean by that is inflation, as it's currently stated in the current readings, we actually have a very tangible understanding of why inflation is where it's at. It's not a phantom pop in the consumer price index. We can actually quantify and visualize what's happening in the California ports, what's happening on the East Coast.
Yep.
And it bears significance to note that the Fed's transitory description of a lot of these inflationary pressures makes a lot of sense because we can quantify it. I would argue once that starts to maybe subside a little bit, we're certainly not going to see CPI back in the 1 to 1.5% range. But I think we may be setting ourselves up for that 2.5% to 3% annualized sustain inflation over the next couple of years, which I would argue is very healthy, and we need it. Something we haven't seen in the previous decade, really,
Sure.
Here in this country.
They're trying to, and it can never get it. And it's in the follow-up that we have to do, though, before closing out the conversation, is on that specific quantifiability of the inflation being transitory. Because as you described, we can see it. We can see the ports. We can see the labor shortages physically and in the data. But does that translate into defining a timeline for transitory? Because it's month after month. Last month it was this commodity. Next month it's going to be this one. Right now it's cotton going berserk to the upside. So how do we get rid of volatility in the market until we know actually what that means, that transitory definition?
So for us here internally, the number one way to quantify transitory in time frame is to gain a better understanding on when the labor market may start to actually become a little more normalized. And I think for the labor market to become more normalized, that's a critical key in various supply chain issues and what have you. The biggest catalyst for that, Oliver, is going to be in tracking unit labor costs over the next couple of months. Unit labor costs and the adjustments that are happening across pay structures for essential jobs across the economy, we're starting to see pressure in that realm. Once that occurs, I think it will cause minuscule pop to inflation. However, I think post the fact, we start to see a more smoothed out CPI figure as a result of the benefits that arise from that. So, again, time frame, really difficult in the transitory nation. However, labor market is the key before we can actually even begin to quantify that.